So welcome to Jumbo IS and welcome to lecture number 2 of economics in this lecture series called Prelims Powerplay 2026. Now in this lecture series, we will completely revise your entire syllabus for UPSC Prelims examination by just spending 1 hour every day. That's it. You just have to spend 1 hour every day from today till your prelims examination and your entire syllabus, static plus current affairs, everything would be revised through this lecture series. But this lecture series would be useful for you or would be able to help you clear this prelims exam only if you follow these 4 golden steps. Now, what are these 4 golden steps? Well, number 1 is watch this lecture regularly. Number 2, revise and memorize this lecture from the notes provided by us. Then, if you have any doubts, clear those doubts immediately. We have enrolled you in our WhatsApp groups. Just ask your doubts and we'll help you out over there. And then number 4, very important, give the tests regularly on time. These are the 4 steps that you have to follow. Only then this lecture series would help you out. You wouldn't have to refer to any source for revision. Just this would do. But follow these 4 steps. Now, lectures would come on YouTube, but for notes, for WhatsApp groups, for tests, you would have to register on our website or on our app. The registration details are given in the comment section below. And in the comment section, there is also a number. If you're finding any difficulty for registering, well, just give us a WhatsApp on that number. All right? Okay. This is the introduction. Now let's talk about today's lecture, and today's topic of discussion is government budgeting. Now this topic is actually related to our previous lecture, which is fiscal policy. In previous lecture, we talked about budget being a fiscal policy document, right? Now the thing is, union budget is part of your syllabus if you're preparing for UPSC. We all know that on 1st February, the budget is presented and well, it becomes a part of your syllabus. Whatever is announced in the budget becomes a part of your syllabus for your exams, right? But when we study budget, when it comes out, when we study budget, we focus more on government schemes announced during the budget, what announcements were made, what tax proposals were given during the budget. All our attention goes towards that. But we forget the static portion behind the government budgeting process. Okay, there are certain static processes, static concepts that we ignore. Like what is revenue account, what is capital expenditure, what is capital account. All these static concepts are also important for you to know because questions can be asked from there, right? So today we will cover the static portion of government budgeting. Okay, what is this entire government budgeting process is all about? Okay, some static concepts like what is balanced budget, what is golden rule of public finance, all these concepts would be covered today. When the budget would come out next year, we will then focus on schemes and announcements made in that budget. But these static concepts would be covered today. Okay, so today we will talk about government budgeting. Clear? All the important facts that you should be aware of. Mostly the lecture would be static. Current affairs portion of this government budgeting topic would be covered when the budget would come out, right? So let's begin. Okay, so budget, economics lecture number 2. Now, the thing is that presenting budget every year is a constitutional duty of the government. Do you know this? Of course, you should know this. Okay. Our constitution makes it clear that every year the government should present a budget. Okay, every year. Now, which article of the constitution says that? Article 112. Okay, so Article 112 makes it basically, it makes it compulsory for the union executive, okay, to present a budget. But there are 3 important things that you need to know about Article 112. Okay, because while presenting a budget, 3 instructions are given to the government. Okay. First of all, you should know this, that under Article 112, the Constitution doesn't use the term budget. Okay. Budget is basically a popular term that is used by us. The Constitution uses the term annual financial statement. Okay. Make sense? So for Constitution, the official, so you remember this, the official word is annual financial statement. Budget is not a constitutional word. Remember this because they can create MCQs out of it. Okay. So yes. Now the Constitution says that every year the government shall lay before both houses of parliament, well, annual financial statement. Now the Constitution makes it clear you have to do it every year. So this is duty number 1. Okay. Then next duty is the Constitution makes it clear that the document that you should present in the parliament, okay, the document that is called annual financial statement. Well, budget is basically the financial account of the government, right? Now that financial account of the government should be separated into 2 parts. The Constitution says that. Okay, capital account, revenue account. By the way, the Constitution doesn't use the word revenue account. The Constitution says that the document that will be presented should have separate components, capital account and other. So the Constitution uses the term other for revenue, but we all know it means revenue. Okay. So these are the three important things that you need to know about Article 112. Okay. First of all, it is called annual financial statement as per the language of the Constitution. Then you should present it every year. This is a constitutional duty. And the document that you shall present will be separated into two parts, capital account and other. The other is revenue. Simple? Make sense? Now let's talk about budget. Okay, now let's talk about these two accounts. That is very important. Okay, so yeah, fiscal policy is nothing but government budget. Remember this, because government budget or annual financial statement is fiscal policy document. Okay, now this budget, as per the constitutional instruction, is divided into two parts, revenue account, capital account, right? One more thing, you should know this about government budget. Okay, government budget is nothing but an account of government's receipts and expenditure. The money coming to the government, receipts, the money going out of government accounts, okay, expenditure. Budget is nothing but a document presenting government's receipts and expenditure. Simple. The Constitution said that these receipts and expenditure should be separated into two accounts, revenue and capital. Clear? Simple. So first let's talk about this division. This is important. Questions, MCQs can be asked from this. So pay close attention, okay? So about revenue account. So revenue account has receipts, expenditure. Capital account has receipts, expenditure. Simple. Now, they can ask you questions with respect to the difference between revenue and capital account. Okay? They will give you an expenditure and ask you that is it revenue expenditure or capital expenditure. They will give you an example of a receipt and ask you whether it's a revenue receipt or a capital receipt. Okay? Now, I will explain this difference so that when such questions come, it is very easy for you to solve. Clear? But initially, I'll just tell you that, well, revenue account is government's day-to-day expenditures or day-to-day receipts. So day-to-day expenditures and receipts are mentioned in revenue account. Long-term expenditures and receipts are mentioned in capital account. This is just a preliminary difference that I'm telling you, okay? I'll explain this difference in detail when we'll come to capital account. After understanding that difference, you will face no problems with respect to differentiating between the two accounts. Okay? But just remember, this preliminary definition, just remember, this is day-to-day, this is long-term. Okay? So revenue account has receipts, expenditure, capital account has receipts and expenditure. So first, let's talk about revenue account. Okay? So this is revenue account. Now in the revenue account, government receives some money, right? Now this money that is coming to government can be also further subdivided into two parts. Tax receipts, non-tax receipts. So money coming to government in revenue account, okay, is divided into tax receipts and non-tax receipts. Very simple. Tax receipts, money coming from income tax, GST, sales tax. Sales tax is subsumed under GST, but import duty, all these taxes, tax receipts. Then some money comes to the government in form of non-tax receipts. For example, there are so many government PSUs, government companies, they are earning profits, non-tax receipts. Similarly, government collects challans, fines, all these things, non-tax receipts. Similarly, well, let's suppose government gives a loan, union government gives a loan to Tamil Nadu government. Now, every year, Tamil Nadu government is paying interest on it, right? That is non-tax receipt for union government in Delhi, right? So, tax receipts, non-tax receipts. The examples of non-tax receipts are given in your notes just to make you understand this part better, okay? So, this is the thing. Very simple. Receipts, tax receipts, non-tax receipts. By the way, taxes are also of two types, direct and indirect, right? Income tax, capital gains tax, corporate income tax, these are direct taxes. GST is indirect tax. Import duty is indirect tax. Okay? Excise duty on liquor and all, indirect tax. Clear? We won't get into this direct indirect difference in detail. We'll focus more on budget. Okay? So this is revenue receipts. Then there is some expenditure also. Well, revenue expenditure. Now some examples of revenue expenditure. Well, government has taken a loan from World Bank. Every year, government is paying interest to World Bank. That is revenue expenditure. Interest paid on loans, okay, taken by government. then salaries and pensions given to its employees, then subsidies and welfare payments for the poor, defense expenditure, salaries to defense people, their food, clothing, and many other expenses, defense expenditure, grants given to states. Central government also gives grants to states. That is part of revenue expenditure. Okay, and etc. Many more. Clear? So this is revenue account. Very simple. Go through this revenue account in your notes. Clear? Very simple. Now you will understand the actual difference between revenue and capital account. Okay, because we are going to talk about capital account. Okay, so about capital account. Now listen to me very carefully. Okay, you see, the thing is that any expenditure or any receipt which changes either the assets of the government or the liability of the government, that is capital account transaction. So any transaction by Government of India which makes changes into either assets of the government or liabilities of the government, that is a capital account transaction. Okay, now I'll give you some examples. So for example, government takes a loan. When government takes a loan, this increases liability on the government, right? So this money is coming to the government, this is receipts, but that is also creating a liability. So capital account. Let's suppose government pays back the entire loan. Okay, not interest payments, because interest payments would come in revenue account. It pays back the entire principal amount. Okay, by paying back a loan, liability on the government decreases. There is a change in liability, right? Capital account transaction. When the government builds a bridge or a road or a national highway, well, government is spending some money on it, but by spending that money, government is building an asset. Road, bridge, infrastructure, capital account transaction. You understand? Any transaction that makes any change in assets or liabilities of the government is capital account transaction. Any transaction that doesn't make any change in either assets or liability, you automatically put it in revenue account. Just remember this line and you shall never falter when it comes to differentiating between revenue and capital account, because they will ask questions to confuse you. Simple? Okay. Now, let's talk about capital receipts. Okay. In capital receipts, any transaction which either decreases government assets or increases its liability, either the government's assets are decreased or its liability has increased, is capital receipts. And in expenditure, when the assets increase or the liability decreases, that is capital expenditure. And I'll give you some examples. Okay, capital receipts are divided into two parts: debt creating, non-debt creating. Very simple. Okay, those receipts which will create debt on the government, debt creating; those receipts which will not create a debt on the government, non-debt creating. Okay, I'll give you examples. So let's suppose government sells ONGC. ONGC is a government company, right? So when government sells ONGC, okay, government has sold ONGC to Tata, or the latest example, government sold Air India to Tata. Okay, government earned some money out of it, so it is a receipt. But by selling Air India to Tata, Air India was an asset of the government. Now by selling it, it is no longer an asset to the government. So assets have declined, but money has come. Capital receipts. And because there is no debt in this, non-debt creating. This is known as disinvestment. When government sells its assets to earn money, disinvestment, non-debt creating. Similarly, let's suppose government takes a loan from World Bank or IMF. Now that is a receipt, money is coming, but that loan will increase government's liability. Debt creating, capital receipt. You understand? Yes? So these are some of the examples. Clear, of capital receipts. The exact opposite is capital expenditure. Any transaction which either increases, not decreases the assets, increases the assets or decreases the liability is capital expenditure. Okay. So when central government gives a loan to Tamil Nadu government, a fresh loan is given to Tamil Nadu government. Okay. That loan is union government's asset. The loan is given to Tamil Nadu government. That loan is Delhi's asset. So assets have increased by spending this money. So capital expenditure, loans given by central government. Clear? Now when central government has taken a loan from World Bank, is paying interest payments are revenue expenditure. But on the 10th year, let's suppose, it pays back the entire loan. That is an expenditure to World Bank, right? But that reduces your liability. So this is loan paid back capital expenditure. Then remember this thing. We talked about defense expenditure in revenue account. Defense expenditure is of two types. Revenue, which is included over here, and defense capital expenditure. So if you are spending, when Ministry of Defense is spending money on salaries of army people, naval people, on other operational expenses, that is defense revenue expenditure. But when it buys assets like tanks, submarines, aircraft carriers, that is defense capital expenditure, because these are assets, they increase your assets. Okay. And last, expenditure on infrastructure, building roads, bridges, highways, trains. These are infrastructure. Expenditure on infra, capital expenditure. Clear? Mind you, whenever you'll read newspapers or the budget, capital expenditure is basically sometimes mentioned as CAPEX, short form basically. So CAPEX is nothing but capital expenditure. You take cap from capital and X from expenditure. CAPEX is capital expenditure. Just remember this part. Simple. Okay. So this is the thing. Do read about this from your notes. Okay. Many examples would be given in your notes. Yes. Okay. Now, the thing is, let's talk about, you remember in the previous lecture, we talked about certain deficits. Okay. I told you must have studied those deficits in your economics lectures. But some of you messaged me that, sir, please explain those deficits also. Revenue deficit, primary deficit, effective revenue deficit, fiscal deficit, right? So these are those deficits. So what is revenue deficit? Okay, revenue expenditure minus revenue receipts. So let's talk about revenue account. Okay, so let's suppose the total revenue expenditure is 200 rupees, but the money coming to government in revenue account is 160 rupees. So your expenditure exceeds your receipts in revenue account by how much? 40, right? So this 40 is nothing but revenue deficit. Clear? Okay. So revenue expenditure minus revenue receipts, revenue deficit. Now revenue deficit is generally considered bad. That is why it is said that increase your receipts and reduce your revenue expenditure. Clear? But one component of revenue expenditure is not considered bad, and that is grants to states. When you give grants to states, this portion of your revenue expenditure is not considered bad. Remember this. Okay. But you are running revenue deficit. So government, the BJP, so let's suppose the current government, the BJP government is running very high revenue deficit. Opposition parties are criticizing it, right? So the BJP government returns back and says, well, the thing is that we care for states. We are giving so many grants to states. That is why our revenue expenditure is high, and that is why our revenue deficit is high. Okay, so don't blame us. So opposition parties say, okay, then remove grants to states. Okay, remove this portion of your expenditure for a moment and then check whether you still run a deficit or not. Exclude this and then check whether you still run a deficit or not. If you still run a deficit, this is your fault. If you don't run a deficit, then we understand that the blame lies with the states. You understand the point? Okay. So after excluding grants given to states for capital creation, for building assets, sometimes you give grants to states for building assets like roads, bridges and all. Exclude this portion. And now check whether you run a revenue deficit. Okay. The deficit you run now after excluding grants to states is known as effective revenue deficit. So effective revenue deficit is revenue deficit minus grants given to states for capital creation, asset creation. Clear? I hope you understood this. Okay. Now let's talk about fiscal deficit. So revenue deficit is deficit in revenue account. Okay. Fiscal deficit is deficit in total budget. Okay. Total account. Revenue plus capital. Okay. Now the thing is, listen to me carefully. So fiscal deficit should be total expenditure minus total receipts. Yes. The thing is that let's suppose total expenditure is 200 rupees and total receipts is 160 rupees. So what should be fiscal deficit? 40 rupees. So government is spending 40 rupees extra running this fiscal deficit, right? Now where will this money come from? This money will come from when the government will borrow. As soon as the government borrows the money, this 40 rupees, where will this 40 rupees come from? Debt creating capital receipt. Yes, as soon as the government borrows this money, Government's debt creating capital receipt will increase by 40. Capital receipts will increase by 40. Total receipts will now increase by 40. So this will again become 200. Okay. Fiscal deficit would always come 0, because as soon as you finance this deficit by borrowing, your total receipts increase. This is 0. Okay. We don't want to check that. Fiscal deficit is calculated to check how much money does the government need to borrow. Okay. So what do? To calculate fiscal deficit, we only include non-debt receipts. Okay, non-debt receipts. So in non-debt receipts, well, there is revenue receipts. Revenue receipts are non-debt, and non-debt creating capital receipts. This component. This is not added, this is added, plus revenue receipts are added in this component, and then it is subtracted from total expenditure. That gives you fiscal deficit. Simple. Okay. So this is fiscal deficit. Any doubts? If there are any doubts, do ask me those doubts. Okay. These WhatsApp groups are created for a reason. So do ask me those doubts. All right. Okay. Now let's come to primary deficit. Okay. Let's suppose BJP government, the current government, is running very high fiscal deficit. Very high fiscal deficit. And yesterday we discussed FRBM Act. In FRBM Act, we have been told that government should reduce its fiscal deficit. But government is unable to reduce its fiscal deficit. Why? Well, the government should answer that. So opposition parties again question the government, saying that you are unable to reduce your fiscal deficit, you are mismanaging the economy and whatnot. Okay, they level these allegations. Government returns back. Okay, BJP party returns back and says, well, yes, we are running a high fiscal deficit. Do you know why? Because when Congress party was in power, they borrowed so much money that today when we are in power, we have to pay off this debt through interest payments. Our interest payments have increased because you borrowed so much. So it is actually your fault. You borrowed so much that now we are servicing this debt via interest payments. And because we have to pay so many interest payments, our total expenditure increases, our fiscal deficit increases. So the Congress party says, okay, we understand this logic. Then let's do one thing. In your total expenditure, remove these interest payments. Remove all the interest payments from your total expenditure. And then see whether you're still running a deficit or not. If you are, then it's totally your fault. If you're not, then we understand that the fault lies with us. We borrowed too much back in the day, right? Now, after excluding interest payments, the deficit we get is called primary deficit. So primary deficit is fiscal deficit minus net interest liabilities. Clear? Make sense? Okay. Now these terms would be thrown around when the budget would come out next year on 1st February. I hope now you'll be able to understand budget in a better light. Now you know these things. Clear? Make sense? Now one more thing. There are certain key terms that you should be familiar with. Okay. Let's discuss those key terms to understand better budget better. Okay. Certain important terms. So number one, very easy, deficit financing. So whenever you run a deficit, you fulfill that deficit or finance that deficit by borrowing. This is known as deficit financing. Okay. Okay. Next is, whenever you run a deficit, instead of borrowing from the market, you tell RBI, print more money. Print new money and give it to us to fulfill our deficit, to fulfill this shortfall. This is known as monetized deficit. Remember this term. Okay. Then third is balanced budget. When your fiscal deficit is equal to 0, you are running no fiscal deficit, balanced budget. Generally considered okay. And last, very important, golden rule. Okay. Golden rule of public finance. Now, what is golden rule of public finance? Listen to me. Okay. This is an important statement. Golden rule says that you shouldn't borrow money to finance your day-to-day expenditure. You should only borrow money to build new assets. Okay, never borrow money for financing your day-to-day expenditures. What are your day-to-day expenditures? Revenue expenditure. Okay, don't borrow money for revenue expenditure. Now, you won't borrow money for revenue expenditure only if your revenue expenditure is equal to revenue receipts. If that is the case, then revenue deficit will always be 0. And whatever money you are borrowing for capex. Okay, so your fiscal deficit is there, But that is not because of any problem in revenue account. Whatever fiscal deficit is there, you are borrowing money for it, but that money is going towards capex. Capex is considered good expenditure. Revenue expenditure is considered bad expenditure. Salaries, subsidies, all of these things are considered bad. Make sense? Okay. So this is considered bad expenditure. Simple. So golden rule says that borrow money, but only for capex, not for revenue expenditure. Revenue expenditure should be financed through revenue receipts. Therefore, under golden rule, your revenue deficit should always be zero. Make sense? Okay. That is the thing. All right. Now, there are some other terms which you'll understand just by reading the definition from the notes. Okay. Types of budgeting, what is outcome or performance based budgeting, zero based budgeting, what is gender budgeting. All these terms are explained in your notes. Do read them, you'll understand them. But if you don't, well, you can ask me, okay, in the WhatsApp groups. I will create a separate lecture to explain them if you have any doubts. Otherwise, I think these terms are self-explanatory. All right. And now let's talk about one last thing very quickly. Different estimates. Okay. You see, when this year's budget was presented, well, it was presented on 1st Feb 2025, right? Now, do you know what is a financial year? There are two types of years. Calendar year, which begins on 1st January and ends on 31st December. Financial year, which starts on 1st April and ends on 31st March of next year. Right? Yes. So, financial year is this. Therefore, when this year's budget was presented on 1st February, February was the month of which financial year? 2024-25, because this financial year began on 1st April 2024, ended on 31st March 2025. But the budget is presented on 1st February. Okay. Now, this budget that was presented was known as budget 2025-26. Why? Because it gave estimates of receipts and expenditure for next financial year, which began on 1st April 2025 and will end on 31st March 2026. Yes? Make sense? Okay. Now remember this. Well, when the budget is presented, there are certain estimates that are given. Okay. That income tax would be 10 lakh crore estimate. This estimate is given. Okay. Capital expenditure would be 5 lakh crore. This estimate is given. All estimates are given in the budget document. Well, whenever they say budget estimate or they write this term BE, BE means estimates of next financial year, which will begin on 1st April 2025 and end on 31st March 2026. But we are presenting the budget in 1st February. That means we are just making an estimate. We are just projecting. We are just guessing. And it's a good guesswork, but we are just estimating this. Clear? This is budget estimate. But some data of previous financial year or the current financial year 2024-25 has come out. Okay, those estimates have to be also presented. Those estimates will be presented as revised estimates. RE. So whenever you see the term RE in front of anything in the budget, that means we are talking about current financial year. Whenever there is BE, we are talking about following financial year. And later, 2 years later, actual estimates also come out, but we'll talk about them sometime later. As of now, just understand budget estimates and revised estimates. Make sense? Okay. And that would be all. I hope you understood certain minute facts about government budgeting. Okay. You understood them, but if you did not, ask me your doubts. Okay. I am begging you, pleading you. Okay. If you don't understand, ask me your doubts. Okay. You are there in WhatsApp groups for a particular reason. So do ask me your doubts. All right. And if you don't have any doubts, well, go on. Watch the lecture, revise and memorize it from the notes, and well, give the test on time. Okay. On that note, I'll be signing off with the promise of seeing you again with another topic of economics in this lecture series called Prelims Powerplay 2026. Thank you, everyone.